Good evening. Happy Wednesday. What a day, huh? Nice week so far. Uh, I'm glad we were able to make some good trades today. And, well, I mean, it's just been a really interesting market, and we've been able to, extract some nice profits along the way. Okay, the cues. If you notice, the last 3 or 4 days, I've been mentioning, it's been hitting his head on the 21 downward moving average. It has not cleared that 350 range, 347 today. And it's been in decreasing volume. Today it was negative 12% volume day. In other words, it was 12% less volume than the average volume. So you never want to see an up day with a negative volume surge. That means there's no oomph, there's no consistency, there's no sustainability to this uptrend. That is why I was getting out of my shorts, getting out of my longs today, and clearing the deck out, and actually started to increase my hedging. And then at the end of the day, I actually went directionally short. So I'm currently 220 short deltas in my portfolio. In other words, I am short the market. Why? Because of this. I'm seeing 1, 2, 3, 4 days in a row, and we're not even near that 350 and the 21 exponential moving average going down. If you notice, let me clean this up. If you notice, from back here, it has gone up to it. It has gone up to it. Then he lost it. Then up to it again. So it's been hitting his head on this downward moving average. That's why I say moving averages work. You know, we had the beginning here of a death cross, which is the 50-day moving average crossing below the 200. That is not a good sign. I mean, I don't know when was the last time this happened. Oh, right here. You know, on the weekly. These are weekly bars, okay? Weekly. So every bar is a week. So when this happened right here, look, it hit his head, and then boom, it was from, like, let's say 170 to like 140. That's a 30-point move. That means, like, that's 3,000 points on the Nasdaq. 3,000. When you have a 400 down day, it hurts, right? Well, imagine 3,000. Okay, that's when you had that death cross. And then once you have what's called the golden cross, when the 50 breaks above the 200, then you have a sustained rally. Once it broke up here, it kind of came back over here, but it's basically a sustained rally until we had the COVID crash back here. So, if you would have got in the market right here, let's say at 180, I mean, you got out, let's say at the COVID crash at 220, again, that's 4,000 points on the Nasdaq. So that's why I'm saying about good sustained uptrends above the 50, below the 50. Even if you just took, if you got out of the market when you broke the 50 here, you saved yourself from 180 to like 140 basically. That's huge. Okay, so this is scary. Again, we can kind of trickle, and then go up again. That's perfectly fine. But until I see it, I am trading what I see, not what I hope or expect. We still have to go above this downward trend line, hit his head here, hit his head here, hit his head here, and then lower lows. The 21 has to be cleared over 350. Then here, for me to be content with, like, okay, let's really put the the foot on the gas pedal, and let's get aggressive here. Okay, and let the stocks that we hold, run longer. Right now I'm taking quick profits because I'm seeing this right here. We're hitting our head. So why am I gonna keep up bumping my head against something? I'm thinking that, okay, this time will clear. Well, until I see it, I won't trust it. And again, decreasing volume. That's not good. You want to see, increasing volume. Like when this is going up, and then you want to see like big volume bars. Right here. when we kind of eventually went higher, you have big volume bars. So I digress. So this is why I started shorting the SQQQ. I started buying the SQQQ. The SQQQ, it's an inverse. So it goes against the market. That's why it's going down, because the market's been going up. So, so when you want to short the market, instead of actually shorting the actual QQQ, you buy the SQQQ, and then it's basically shorting the market. So I'm right about 40, right about here. So it's already up after hours, because the Qs are down about 0.5% after hours from the top. So again, I am trading probabilities. Okay, the MT was at 90, 91, 92 today. So that tells me we're extended. I've been saying it. We're toppy. I've been clearing out all my longs as much as I can, and actually, going short. If I'm wrong, if the market rips higher tomorrow, awesome. I'm gonna be stopped out, and I'm gonna lose a couple $100, and no harm, no foul. If I'm right, this goes down a couple 100 points, I'm gonna make a lot of money. So it's not about making money, it's about just trading probabilities. I constantly trade probabilities. I'm not worried about making money. I'm worried about not losing a lot of money. So I trade with an edge. If my edge tells me there's a higher percentage chance that this goes down instead of up, I play down. If my edge tells me there's a higher percentage chance that this goes up instead of down, I play up. That's all. That's as simple as that, guys. As simple as that. So let's see what happens tomorrow. Okay. So stocks. I'm going to go through stocks that I'm looking at. Which again, if the market is down tomorrow, I'm not necessarily going to be going long anything, but these are decent setups. And if we go up tomorrow, these are good setups. I'll get this in a second. Also, another thing I wanted to cover. Feel free, have enough confidence that any of these setups that I give you on these videos for the day, even if I don't take them, even if you don't see me posting that I took the trade, and if you see the setup working and the price trigger, go ahead and take it. If you don't feel confident, ask me, shoot me a quick text. And listen, I'm seeing this number, break out from what you said. Do you still see it as good? And is it, whatever? Just ask me, and I'll confirm, deny. I'll give you my take on it. But if I'm telling you, XYZ stock at $30, it's a buy, and then tomorrow it goes to a 30.05, it's a buy. Simple as that. And your stop is at 29.88. You lose, $20 to possibly make a couple hundred. Just that simple. Just because I don't take the trade doesn't mean that you can't or you shouldn't. Feel confident. Okay. Example, ARCH. I gave you guys ARCH yesterday at a 125.22 price. 125.22 price was right there. It went up 13 points today. If you would have bought 100 shares, you would have made $1,300. Let's say you would have gotten stopped out at 12. You made $1,200. It broke the base that I gave you. There was an entry here. You could have taken it, and it was on volume. Look at this volume bar. Look at this, 200% volume increase. That's where you have power. You have oomph right there. Let me clean this up. When you have volume, accompanying the breakout, that is just an equation for like just monster profits. And there it is. You could have taken this at 125.22. I alerted it. There it is. The other one, HSY, Hershey. I've been at it for a couple days. Remember Hershey? Hershey broke out. He broke out in this early cheat entry, and he broke out again on the traditional entry. I gave the entry at 206.15. If you go to yesterday's video, you're going to hear me say ARCH 125.22, and you're going to hear me say HSY 206.15. 206.15 at 208, you could have made a couple $100. Okay, so feel free to take the entries. Just because I don't take it, it doesn't mean that you shouldn't or you can't or whatever. You know, I'm not saying you can't. You can do whatever you want, but I'm saying like feel free to take the entry on your own, even if I don't post it, because I might be overly exposed on a particular sector, and I don't want to add like another 7 stocks to like oil or whatever. This particular case is not oil. You know, I could have taken it, but I missed it. I didn't take it because I was already overly exposed on other things. But again, just I'm digressing, but I want you guys to feel confident. And if you don't feel 100% confident, just ask me at that moment that you're ready to take it, and I can confirm or deny or give you my take on it for you to have more of an educated opinion on the overall trade. Okay? All right. So what I'm looking at for tomorrow, SM. I'm looking at SM 4010. I want to take out this high here, 4010, SM. WLL. I currently have a quarter position still on WLL. It kind of broke the 80 that I was looking at, and it came back inside, but it kind of came back and closed right at it. So I got stopped out when it got down here. I got stopped out for a very small loss, but I still kept a quarter position. If tomorrow it takes off, I still have a quarter position. That's why you never buy in 100% of your shares, and you never stop out 100% of your shares, because you scale in. So if you want to, for 100% position, you might buy in with a 50% entry or quarter entry, and then add to it if it builds on it. If it builds on it, you add to it. And then same thing with stopping out. I personally, my little setup that I do, my system is 1/3, 1/3, 1/3. 33% of 1.5 trading stop, 33% of 3.5 trading stop, and the final 33% at a 5.5% trading stop. I will never let a stock go below 5.5% of where the high of that stock is. So if I buy at 100 and it goes to 107, then I'm probably going to stop that at 102 if it comes back inside. So I got a guaranteed profit. And along the way, I'm being stopped out at 1.5% and 3.5%. So overall, this whole setup right here is roughly about a 4%. It's roughly about a 4% stop. So that is risk management. I'm looking to make 7, 8, 9, 10, 12, 15%, and I'm giving up 4. That's a good 3-to-1 ratio, 2-to-1 ratio. I could be wrong 6 out of 10 times, which is bad, and it's still going to be a very profitable trader. Okay, that's just my system. You guys do whatever works for you. That's just what I do. The next one, CLR. CLR, I'm looking at 60-20. I want to break this little top right here. 60-20. MGY. MGY. 23.35. 23.35. I want to take out this high right here. BSM. 12.77. 12.77. I want to take out this high right here. DVN. 60.10. 60.10. I want to take off this high right here, get above 60, and take off. RRC. 26.55. 26.55. Take off this high. SQM. 67.55. 67.55. Take off this high right here. TRQ. 21.65. 21.65. You can have a little cheat entry right here, but it's kind of almost the same price. So I want to take off this little high here, 21.65. Again, the earnings weren't that great, but look at their sales growth. Again, look at the sales growth, and the estimates for this year are a little bit higher, and it's the top 10 group. I'm gonna go over this in a second here, and then NCBS. I think NCBS. Is that what it was? NCBS. Yeah, NCBS. 96.75. I'm playing the 100 play. 96.75. I want to break this high right here. Nice little consolidation here. If it breaks 96.75, it could easily go to 100, 102. I'm taking profits. Let it work back inside, and then once it ticks up again, I'll buy some more and let it ride. Okay, look at this. Look at this. Look at this. Look at this. If you bought it right here at 79, nice. Again, not great numbers, but sales are increasing over 25% from last quarter. Okay, and look at the estimates, increasing. Okay, it's not sexy. It's a bank, but you can't argue with this price movement. You can't argue with this. I mean, you just can't. Even if you bought it back here over 80, you still took it to 95. I mean, come on. So I want to also go over, that's enough of stocks. I want to go over the premise of merchandise. In other words, okay, Etsy, perfect example. It went from like 130 to like 160. Great, a 30-point move. I'm perfectly happy missing this. I don't care about this. Look at this. That's very low probabilities. Okay? I want to do something like, you know, when it's doing this, not when it's doing this. Okay? Like right here, you could have bought Upstart at 120 and it's at 160. Great. It's still below 200. I don't care. I want to buy it at 200 and take it to 346. Okay? Because this right here is not sustainable. This right here, once it breaks, you know, this right here, then it's sustainable up here. I don't want to mess with this because there's no probabilities here. I don't have an edge. I have an edge here because I know that if it breaks this high, it's going to go higher. And if it doesn't, I get out right here. This is not a high. This is a high. So you want to work your setups that, you know, the little base shelf setups and the breakouts on quality merchandise. Quality merchandise is stocks that, let me see here. Look at something that worked recently. Okay, well, ARCH, basically perfect example. You know, you want quality merchandise. In other words, you want stocks that are in leading industries with over 25% growth quarter over quarter in either sales or in earnings. You don't have to have both. That's great if you have both. You know, like here, you have both. But you don't have to have both. As long as one of them, it's over 25% quarter over quarter, it's growing. It's perfectly fine. You want accumulation. In other words, you want the institutions to be putting money into this, and you want, you know, obviously lower left to upper right. You want it to be above the 50, above the 200, and ideally you want an RS rating, which is the relative strength of the market, of 85 or higher. That's quality merchandise, and it does stuff like this. Even back here, you know, it broke about 105 and you took it to 130 or, you know, 120 if you got stopped out, stuff like that. You don't want to chase every little shiny object. You don't want, like, you know, stocks that everybody knows that just because you know it's a great company like a Square or a PayPal or so forth. If they're not working, they're not working. You want companies that are working. And my scans provide you this every weekend when I send you that list. Those are the best stocks that are working right here, right now. In other words, the top 40 industry groups that have growing sales, growing earnings, and are moving in the right direction. They're above the 50, above the 200. That is a dynamic list. In other words, every week that could change. If 3 weeks from now, a new industry sector, computer software or retail or whatever, starts gaining strength, my scans are going to pick it up, and then those are the stocks that we're going to be looking at, and those are the ones that are going to be the ones that we trade in those setups. So we are always trading what's working. We're always trading the top 40 in industries. We're always trading stocks that have great numbers, great earnings, accelerated growth, always, because that's what my scans pick up. So if you want to go and just completely just on your own study and then do your own work and research, that's your merchandise. Don't go outside that list, because outside that list, It's not curated. It's not what's hot right now. What's working. What's growing. So I just want to reiterate that, like, quality merchandise, it's the key, and then the proper setup. This is not me saying it. It's just like research, and it's been documented, and that's just what I've read in all the books that I've read in my career. 87% of all the companies that have had multiple X of growth, in other words, they've doubled, they've tripled, they've gone up 30, 40, 50% in a year or more, all of them, 87% of them, 87% of those companies have been in the top 40 industry group at the moment where they took off. In other words, like, let's say this is, you took this from like, 60 to like 137. That's like 100+% return, right? If you took it from 60 to 130, that's more than double. You had 120 here, you have 100. This is a double. In what, less than a year? From May to March. If you would have traded this breakout right here at 60, 61, 62, and you took it all the way here, yeah, you would have gotten stopped out here, but you would have gone back in and so forth. This is a double, okay? What was the stock doing back then? It went from this to this. More than 25% increase in sales, more than 25% increase in earnings. It was above the 50, it was above the 200, and I guarantee it was in a top industry group. Okay, so 87% of these stocks do this, have these qualities. That is what I scan. In my scans, these are my parameters. This is what I search for. If it doesn't meet those parameters, it doesn't get picked up. Okay, so if you have a nice growing company that is growing sales, my scans are going to pick it up. So quality merchandise. Now, why would I want to trade and find the other 13% and make it hard on myself? Just play the probabilities. The biggest winners in the market for the last 50+ years have had these qualities. They've been in the top 40 industry group at the moment, and they have had quarter-over-quarter growth of 25% or more in either sales or in earnings. Just that simple. Then once you have that, that's the merchandise. And then you look for the setup. You look for the breakout on volume. Okay? Like this little breakout right here, when it has volume, it takes off. Okay? I hope that helps. Any questions, please? Anything I'm going to go over deeper, let me know. I'm here. Let's make some money tomorrow.